What's up, Banter fam? Welcome back to the show. It's your host, Miles, and in this show, I interview the biggest guests in the crypto world. Today, we have Haseeb from Dragonfly Capital. Welcome, Haseeb.
Hey, good to see you, Miles.
Good to see you as well, man. I've been looking forward to speaking to you for a while. There's a lot to talk about. I want to discuss your fund, Dragonfly, of course, altcoins that you're looking out for in 2023, how long this bear market might last, the best upcoming projects, how to approach the market as a retail investor, and much, much more. So we got a lot to discuss, man.
Let's get into it. Where should we start?
So I guess the best place to start is just tell us who's Haseeb. Tell us a little bit more about yourself and your background.
Yeah, absolutely. So I have kind of a circuitous path coming into crypto. Before I ever got into crypto, I used to be a professional poker player. Did that for about 5 years. I was 16 years old till I was 21. I used to be ranked one of the top 10 online no-limit hold'em players in the world. Made a lot of money at a young age. A lot of poker players found their way eventually into crypto, but I ended up taking a roundabout path. After I quit poker, I was 21, went back to school, became a software engineer. I was working at Airbnb when I first caught the crypto bug. Came into the space full-time in 2017. First at a company called 21 that got acquired by Coinbase. Then I started my own startup working on a stablecoin when I ended up getting recruited by Naval Ravikant to join a fund called Metastable Capital, which is one of the very first funds in crypto, founded back in 2014. That's where I got my start on the investing side. And so when I was there, did a lot of early stage investments into kind of the 2017, 2018 cycle, investing mostly into kind of core technology like L1s, L2s, the internal infrastructure that today is kind of what runs crypto. And it was when I was there that I ended up meeting Bo, who's the other managing partner at Dragonfly. He and I decided to partner up together, and I've been at Dragonfly ever since. So I now am one of the managing partners at Dragonfly, which is a global crypto venture fund. We invest globally across the industry into primarily early stage and then some mid stage projects. So we invest into CeFi, DeFi, L1s, L2s, NFTs, infra, custodians, brokerages, exchanges, everything under the sun within crypto. We do it. We've been investing in the space for a while and intend to be investing for a long time hence. So that's me in a nutshell.
Amazing. You've kind of, it seems like you've done it all already. You've been kind of obviously Web 2, then have gotten into Web 3. Kind of rewind a little bit. I'm interested to hear more about your poker days because you were quite a good poker player, I've heard.
Yes. So I started poker when I was 16, which was like at that, it's a really young age to be inculcated into the world of risk and money. One of the things I learned as a poker player from a young age, like a lot of the things that you see in crypto culture, I saw as a poker player, because I think every generation has its own hustle. Back in my day, it was online poker. If you were really smart and you were hungry and you were not willing to look, you were not afraid of looking stupid, then online poker was the thing that you learned how to play. And then, years later, it became fantasy sports. And years later, it became, ICO trading. And then years later, it became NFT trading. Every generation has that thing. And, next it'll be something else after, NFT trading comes and goes and all the alpha is wrung out of it. And so in that time, like I knew what it was like to be around a lot of young people who were making a lot of money, much faster than any of their peers, doing something that the rest of society saw as being very strange and very subversive. And the thing that you learn very quickly is that money doesn't buy happiness, because there are a lot of people who made a lot of money and most of them are unhappy. And I think I internalized that lesson at a young age, but I also learned a lot about risk taking, a lot about how to manage your own psychology. And so in some ways, I think parts of that ended up being a very good education for what I would end up having to understand as an investor, especially in the crypto industry, where there's so much volatility, there's so much noise, and there's so much, it's so often that you see people who end up looking really, really successful and turn out to have been basically just kind of, crazy hyper leverage monkeys. Yeah. And that's especially a timely observation given what just happened with FTX and with Sam Bankman-Fried. But it's true every cycle. Doesn't matter where you are in crypto. There's always, every single moment you look, there's always somebody who is making crazy returns or making crazy money or got every single call right. And almost always the next year they end up losing it back. Somehow, it's very seldom the case that the person who makes the most money in any given year is the person who makes the most money the next year. And there's a great insight by actually Nassim Nicholas Taleb, which reflects this, where he says, any given year, he's talking about sort of day trading or just general financial markets. Any given year, it's almost always the case that the fund that performs the best in any given year is not the fund that performs the best the next year, because the fund that performs the best in any given year is almost always overfitted to that market regime. And when the market regime changes, that fund is very seldom able to adapt. And so it's the same thing in poker, actually. The best poker players in the world are not necessarily the people who are making the most money any given month or any given week. If you look at who made the most money this week, almost always, it's kind of like who wins the World Series any given year. It's almost always someone who's pretty good, but it's almost never the best player in the world. Because if it was, of course, it'd be the same person every year, and it's not. It's some random guy on any given year. It's some random guy who's pretty good, but it's not the best player. The best players are the ones who almost always make the final table, or who almost always make the top 20, the top 30. They're always in that top decile of performers. That's what it means actually to have repeatable success as an investor. And so you see, you can think of them. I'm not going to name names, but you think about who was looking invincible last year, who was looking invincible in 2020, who looked invincible in 2017. Almost never are those funds the ones that end up performing the best over a long enough time horizon. And that insight is one that I think I learned as a poker player, carries through to poker, investing, and everything generally.
Yeah, so clearly that obviously had a big influence on your crypto journey, which has led you to Dragonfly today. So apart from having the coolest website in crypto, what does Dragonfly do? Just to give the audience an idea, it's a great website.
Oh, thank you. Yeah, we put a lot of love into it. What we do fundamentally is we partner with early stage entrepreneurs and we help them build awesome things in crypto. So, we've been there from the very beginning with things like, we invest in the seed round of Avalanche, seed round of Near, seed round of DYBX, seed round of 1inch, seed round of Dune Analytics, seed round of Matrixport, Amber. So we've partnered with a broad swath of founders that were building really important things, whether in CeFi, whether in infrastructure, whether in data, whether in DeFi or layer ones. And we help them make this shit successful. And part of what also makes us unique is that we're also very global investors. So we have a presence in Asia, we have a presence in the US, we have folks in Europe, we're pretty geographically dispersed all over the world. And of course, if you look at crypto objectively, huge part of what's happening in crypto is outside of the US. It's outside of the Anglophone market even. Huge amount of it is in Asia, right? If you look at all the top exchanges, at this point, all of them are in Asia. There's not a single top exchange that is in the US or in the West, right? If you look at total volume. And if you look at the total number of users, you look at adoption, you look at any metrics that are actually substantive indications of where the center of gravity is of crypto. The answer is that it's global. It's spewed across the world, and Asia is an enormous part of it. And most of the investors in crypto don't have any presence in Asia, don't even really understand what's happening in Asia. And that for us has always been the kernel of our DNA is this idea that crypto is a global phenomenon. And so we are ourselves global. Because if you don't understand the global picture, how are you going to invest in it? If you can't see the whole elephant, how are you going to tame it? That's the way that we see the crypto market.
So obviously it's been a crazy year. Like we've had Luna, we've had Celsius, BlockFi, now FTX, now the recent Binance FUD. So from a business perspective, like how did you guys find 2022? How did you manage to navigate the year?
Yeah, so we've been relatively fortunate this year in that if you look at the big potholes, right? If you look at FTX, Luna, BlockFi, Three Arrows, Alameda, Celsius, Voyager, we didn't invest into any of them. Even things like Axie Infinity, which is down 90+%, we didn't invest into. And so I think a lot of the big foot guns we managed to avoid. Now, that being said, that doesn't mean that there weren't failures in our portfolio. There definitely were. And no matter where you are in crypto, even if you're far away from the blast radius of some of these events, they affected you. It doesn't matter what you hold. You got hurt this year being in crypto. So we're no exception to that. And it's been a tough year. But, to be honest, if you look last year, at the end of every year, we do an investment retro where we look back over the biggest deals of the year, whether we invested in them or whether we didn't invest in them, and try to understand, what do we learn? What do we miss? What do we get right? And last year we were reflecting on like the really big investments that we missed, that we messed up. And those big investments that we were reflecting on, like, how do we get this wrong and what could we have done to get this one right in the future? The investments we passed on were FTX, Luna, Axie Infinity, and Solana. And the question we were asking ourselves is, how could we have gotten to yes on these? Because we passed. Every single one of them we passed. The conclusion that we arrived at was that we are too demanding. We are looking too much for problems. And when we see these problems, we end up being like, no, I don't think this thing is going to work. And we're sort of too incredulous. That was literally the answer that we got to at the end of last year. And then it turned out that almost everything that we anticipated could go wrong went wrong with these particular investments. And I think we're actually about to do our annual investment retro for 2022. And the lessons, I think, are going to be very different. And the lessons, at least for me, is that, look, in the long run, you cannot escape mechanism design. If your mechanism design is broken, it will eventually catch up with you. It does sometimes happen that you start with a broken mechanism and you back into something more robust and more sustainable over time. But it's kind of the exception that proves the rule. Most of the time, if your mechanism is broken, if your unit economics are broken, if you're creating something that doesn't actually net create value, then it is not going to work. It doesn't matter how big you scale it. It's not going to work. That, I think, is the big lesson of 2022 for me. And it's a lot of what I'm reflecting on as I'm looking back and seeing, what we got right and what we got wrong over the course of the year.
So you speak a bit about mechanism design. I kind of wanted to use that as a segue to kind of talk about DeFi. Obviously, some of the issues highlighted from centralized players like FTX, for example, have kind of shifted the focus, at least from a regulatory sense and market sentiment sense, towards DeFi. How do you view the recent events affecting the DeFi market, and what's your long-term thesis on DeFi as an asset class?
Yeah, DeFi performed really beautifully at a time when pretty much all the centralized players were showing tremendous, not just mismanagement, but vulnerability. Even if they were well managed, they weren't able to insulate themselves from the damage that was happening at FTX and elsewhere. In DeFi, pretty much none of that happened. So if you look at MakerDAO, you look at Compound, you look at Aave, you look at 1inch, you look at Uniswap, they all performed amazingly. And none of the problems that you saw in centralized finance found their way into DeFi, which is big vindication for the idea that this stuff is better run without human discretion. The mistakes that we saw from the centralized lenders and from FTX were all ultimately mistakes that came down to people. They came down to human beings exercising their own judgment or their own misjudgment over the assets of other people, whether it's deciding not to margin call somebody when their loan is technically in default, whether it's accepting stupid collateral that in a normal time, you would never accept as collateral, or if it's deciding like, hey, I think it's okay if we grab customer deposits and we make them whole later, as long as we make it back on trading. All those decisions ultimately came down to human beings being in the loop when really they didn't need to be. These businesses, when it comes to trading, like something like Uniswap is just another exchange, or collateralized lending. These are businesses that really don't need human intervention. They actually can be done in an entirely automated way with no humans in the loop. That's the story of DeFi. That story was vindicated this year unequivocally, right? All of crypto's down 70% plus, some things down much more than that. And DeFi performed absolutely beautifully throughout that period when almost every centralized lender failed. Now, you said that the story of what's happening with FTX has turned the focus toward DeFi. I think it's true in more ways than one. In one sense, it's made people realize like, hey, the DeFi value proposition suddenly gets put into sharp relief. Now it's more obvious why DeFi is really attractive when you realize, oh, okay, maybe I can't trust centralized actors. Here's a good reason to understand why that is the case. But the other thing that it does is that you remember, earlier in the year, there was a lot of pressure on DeFi, especially after the collapse of Terra. A lot of regulation and a lot of lawmakers were looking at, hey, DeFi is really bad. How do we control DeFi? Now, actually, the pendulum has swung the other direction. Now, what I'm seeing and what I'm hearing is that lawmakers and regulators are actually less concerned about DeFi now and much more concerned about CeFi. And so the pressure is going back to centralized actors because like, okay, yeah, DeFi is kind of cute. Okay, it has all these weird implications, but ultimately, like, we got to prevent the next FTX. That's what our constituents care about. That's what the headlines are about. That's what, ultimately regulators and legislators are reactive. And right now, the reactive element is control CeFi. So that doesn't mean that DeFi is in the clear forever, but by and large, I think actually surprisingly, the story is resonating fairly well that, hey, DeFi is actually pretty blameless in all this. If anything, DeFi looks very good. So now how does that influence my bullishness on DeFi broadly speaking? I'm bullish on DeFi for the obvious reasons that I think DeFi holds a lot of promise and it's performed very well. But in an environment like we're in right now, macro-wise, where rates are very high, and rates are, what Powell is signaling, what he signaled last week, is that rates are going to be sustained high. What that means for us is that, hey, how is DeFi going to perform in an environment where, nominal interest rates are 5% and they're sustained there for a while, and we could see, significantly positive real rates for some time as well. DeFi is going to struggle in that environment. Where DeFi really came into its own is an environment where we had deeply negative real rates, where nominal rates were zero, and the world was starved for yield. And any form of yield generation, no matter how risky it was super attractive. That's where DeFi was super, super valuable and had huge product market fit. Now, as rates are going up, that is receding, right? We're seeing that it's receding. In the long run, I think DeFi is not going to be primarily about yield generation. But right now, that is what DeFi has product market fit for. And high risk yield is much less valuable in an environment where interest rates are high. So I think for the short to medium term, DeFi is going to continue to struggle. But eventually, rates will turn a corner, rates will come back down, and we will get into an environment where DeFi is relatively more attractive. But until then, I expect that DeFi is going to continue to be sluggish, and we're not going to see a lot of consumer demand for DeFi unless it is for getting exposure to some real world assets, which I think is still a little ways out.
I think for DeFi to succeed as well, it needs to have like really robust apps and an ecosystem that can like withstand damage. So I kind of want to ask you, Avi Eisenberg, he's someone that's been kind of stress testing the limits of some of these dApps. Obviously, we saw the Aave and the Mango markets kind of exploit, I guess, if you want to call it. I was going to ask you, like, what are your opinions on stress testing and what Avi's doing? And do you think it's good, like a net positive or a net negative for the DeFi space?
It's a tricky question. I'd say it's a net positive that there is open stress testing of DeFi protocols. Is what Avi is doing specifically a net positive? I'd say not really. But it's sort of like asking, is it good for your child to go through, like stressful situations in life? Yes. Is it good for your child to get bullied by this particular bully? Like, well, no, but on the whole, it's good that they grow up and like deal with stress. That's kind of the way that I would put the situation with Avi. So if you look at Mango Markets, so Mango Markets and Aave, the lending protocol, two very, very different stories. And so I want to disaggregate those two when we talk about the impact that Avi, Abraham Eisenberg, has had on DeFi. Mango Markets was kind of, it was sort of Bush League, right? It's like this, it's this, perp exchange on Solana. This was at a time when Solana TVL had already drawn down very massively. There wasn't a ton of activity on Mango Markets, and they kind of stupidly allowed you to use their own token as collateral. And Avi, unsurprisingly, was able to manipulate that market and cause a bunch of damage for Mango Markets. That's a very different scale and a very different kind of player than going after Aave. When Avi went after Aave, we don't actually know if Avi even made money on the attack. We know that Avi incurred some bad debt. It's possible that Avi made money. It's possible they lost money. We don't know, because likely if there was money made, it was off chain. But the attack, by and large, didn't do anywhere near the level of damage that people were anticipating it did, right? So Aave had about $1.5 million of bad debt off of 40 million that I believe it was 40 million that Avi loaded into Aave. 1.5 million of bad debt is like less than 10% of the P&L that Aave has even made this year. So on the whole, Aave was actually totally fine. Like, it withstood the attack, had a little bit of a loss, but then changed its risk parameters to make this kind of attack impossible, and went on chugging. And so on the whole, like, what happened to Mango Markets got decimated. It literally got destroyed by the attack that Avi launched against it. Aave, on the other hand, took a hit on the chin, brushed it off, kind of fixed itself up and moved on. So I think actually it's a vindication of the fact that DeFi was incredibly robust. Even with a targeted attack, DeFi held up perfectly. Like what happened to the centralized lenders was not even a targeted attack. It wasn't somebody going in intentionally trying to break them. It was just normal course of business they blew up. And Aave withstood the normal course of business and withstood a targeted attack. And so that to me, like I think that the story is actually really like, wow, even with somebody taking huge amounts of money and intentionally trying to break the protocol, he incurred $1.5 million of bad debt. That's it. That's all. You know, $1.5 million was less than 1% of even the total debt in Aave on the whole.
So do you think it's ethical for him to kind of keep going, keep stress testing the new DeFi protocols?
Is it ethical? Look, I think it's important that DeFi gets stress tested in the same way that, look, I think it's important that your child have something not nice happen to them at some point in their childhood. Is it ethical for you to go around bullying other kids? I would say probably not, but
illegal and unethical are different, basically.
Yes. Is it illegal? I would guess that what he did to Mango Markets is probably illegal. What he did to Aave, less clear. But your mileage may vary. I don't know. Like it also depends. I don't even know where he lives. Is he American?
I'm not sure. I know he's doxxed though, so it's weird. Like if he was American, I'd be pretty worried with the SEC under your purview. So I highly doubt it. He's probably hiding out in Dubai or some other country. A lot of people are going to Bali now. Jushu's in Bali at the moment, so there's a few going there as well. So I kind of wanted to segue a little bit into kind of going back to your origins, but ask you specifically, like, when did you first buy Bitcoin or like your first crypto? Because most people that first enter crypto, usually it's Bitcoin, right? But tell us a little bit about your first crypto purchase.
Well, so my first, the first time that I learned about Bitcoin was actually because after I quit poker, a lot of poker players, there was this event in poker, which was around the time that I quit, called Black Friday. And the Department of Justice went in and shut down a lot of online poker sites. And so if you wanted to continue playing high stakes poker online, you had to play, if you were American, you had to play on some of these Bitcoin denominated sites. And so that was where I first learned about Bitcoin. And my mental model of Bitcoin is that, Bitcoin is like, it's like Skrill or NetTeller. It's like one of these weird ways to pay people online when you can't pay them in a more obvious way. And so it's kind of it's a janky way to settle debts, right? That's what Bitcoin is. And so it wasn't until when Trump got elected, that was actually when I decided, like, okay, Trump is elected. I think that the world is going to, I think the world's going to hell. How do you bet on the world going to hell? And the only thing I could think of was buy Bitcoin. And so that was actually the first time that I meaningfully bought Bitcoin when Trump got elected. Just because of Trump. I didn't really understand that much about Bitcoin. I kind of knew, I knew what a blockchain was. I knew what, hashing was and proof of work and whatever, but I didn't really get the broader Bitcoin story. And so it was really when the ICO boom kicked off and Ethereum really came to the fore that it really clicked for me. And why I wanted to pursue crypto with my own career. It's because I saw what was happening with Ethereum and with the idea of smart contracts and generalized computation finding its way on chain, that this is going to change the way that money works. It's going to change the way that finance works. It's going to change the way that trust works. That was what really convinced me that, hey, what's happening here is much bigger than just here's a different way to pay people. That's what got me super excited about crypto and ultimately caused me to come into the industry full time.
Was Ethereum the first altcoin that you bought, or did you buy something else?
Yes, first altcoin I bought. Yeah.
So, what's your opinion now on Ethereum versus Bitcoin? Do you think the flippening's something that can play out? Do you have a preference from an investment standpoint?
Yeah, I mean, I won't say from an investment standpoint per se, because I just in terms of short to medium term time horizons, this is not how I operate. I'm a long term investor, but at the time when I first got into crypto, like when I first came into crypto full time, I was convinced that Ethereum was going to overtake Bitcoin and Bitcoin was just going to be forgotten. And the reason why, it was a very naive perspective, which I think is very common for people who are coming into crypto at that time, because I didn't really get Bitcoin is a subset of what Ethereum can do, right? Ethereum can just do Bitcoin and more. And Bitcoin is like all these kind of stodgy, hateful people who don't really, they're not very open to new innovations, whereas Ethereum is very developer friendly, such an open ecosystem. They've got all the developers. So Ethereum is obviously going to win, right? That was my mental model at the time because, I was a developer. So it wasn't until much later that I came to understand why some of the properties behind Bitcoin are actually really valuable. And those properties include the fact that Bitcoin doesn't change. Bitcoin doesn't have a lot of programmability. It doesn't have a lot of extensibility. And that actually is a virtue for what Bitcoin is trying to be. And so it took me a while to understand that. Now, if sort of looking forward, what do I think about the relationship between Bitcoin and Ether with respect to, can Ether potentially flip Bitcoin? I think the answer is potentially yes. A lot of the reason why I think it's more possible now is because of the monetary policy of Ethereum. And the fact, of course, also that Ethereum is ESG. And being ESG, I mean, that sounds like, okay, is that like just kind of woke nonsense? It actually does really affect the ability for institutional buyers to purchase this asset in size. And ultimately, if you want to get to $1 trillion coin or more, you're not going to get there on the back of retail. You need institutional buyers to be willing to buy this thing in size. And Ethereum is really the only game in town if you are an institutional buyer, because buying Bitcoin, given the ESG consequences of Bitcoin and given the direction that ESG is moving as an investment criterion, I think it's going to get harder and harder for Bitcoin to really hold on to the ability for institutions to be able to buy Bitcoin and not have to answer questions for it. So, I mean, I just see it because we work a lot with big institutions. A lot of them are investors. It's explicitly something that's becoming more and more of a concern for them is, investing in, I want to invest in crypto, but I have to do so in a way that is compliant with my ESG mandate. How do I do that? Well, most of crypto is moving to proof of stake.
So you think the environmental concern is the major risk around ESG at the moment?
Yes. I mean, again, like it's not a first order concern, right? In the sense that like, it's not as though the person who's running, this endowment is actually themselves that concerned that Bitcoin is causing all this environmental harm, right? Maybe they don't, maybe they think it's kind of bullshit, but ultimately their fund has an ESG mandate and they have to answer to their board about the ESG look through investments that they've made. And so the best answer they can have is like, well, we're not investing in Bitcoin. So therefore everything we own is ESG, everything we own is green. So they don't have to answer to their board. They don't have to answer to their, ESG officer or whatever the hell there is. So a lot of it is more institutional than it is the actual people themselves being like, well, I don't like Bitcoin because it's ESG, because it's not ESG,
yep.
rather.
So if you had to look forward, like let's say 10 years time, what do you think is sitting as a top dog in the market, Bitcoin or ETH?
10 years. I would say, honestly, probably it's 50-50. I think there's a very good chance that Ethereum overtakes Bitcoin. There's also a very good chance that Bitcoin holds on to its lead. 50-50 is kind of a cop-out, but I genuinely think it's a toss-up.
Fair enough. I mean, in general, though, where do you see Bitcoin dominance kind of heading? Obviously, we've seen it drop off substantially over the last couple of years. Like over the last few months, we've seen a spike in dominance. Do you see that like continuing to decrease over time, or do you think it'll kind of find its own narrative again?
I think Bitcoin dominance is largely tied to the demand for risk. And when appetite for risk is low, Bitcoin dominance goes up. When appetite for risk is high, altcoins make a resurgence. So it's kind of a crypto, it's sort of an indicator of the crypto macro cycle, so to speak. I don't know that there are that many more people who are going to hear about Bitcoin and be like, oh, now I get it. Like, I think the Bitcoin story is pretty well penetrated. And a lot of the naive versions of the Bitcoin story, I think, have been largely invalidated. So a lot of people were saying, if you rewind the clock to 2020, a lot of people were saying like, Bitcoin is an inflation hedge. And that's why you want to buy Bitcoin, is because you're worried about inflation, therefore you should buy Bitcoin. Well, it turns out the moment inflation ticked up, Bitcoin started getting killed. And Bitcoin has been the opposite of inflation hedge. It's been very correlated with inflation. And basically we've seen Bitcoin trade, everything in crypto trade like a growth stock, which is the opposite of an inflation hedge. So the reality is that what Bitcoin ended up being good for is, there are two kinds of inflation. There's price inflation, which is what we're seeing now, which is what everybody's concerned about. And there's monetary inflation, which is an increase in the money supply, but not necessarily an increase in the price of goods. So when we saw monetary inflation, which is what happened when all the money printing took place when the COVID stimulus began in 2020. That's when we saw Bitcoin rally. That's when we saw all these risk assets rally. Monetary inflation is in fact what Bitcoin responds to, not price inflation. In price inflation, Bitcoin gets destroyed. And so I think, a lot of this stuff, we're starting to understand better the monetary properties of Bitcoin and crypto assets generally. Now, there's no guarantee that that's going to continue. It might well be that when we move into a different regime where central banks are operating differently, inflation is operating differently, that Bitcoin again kind of mutates from where it is now to some other regime and it starts operating differently again. That's not impossible. I think it's even likely that as we gain a different understanding of Bitcoin and its maturity, it starts behaving differently from how it behaved in the early 2020s. But right now, the best view we have of Bitcoin is that Bitcoin is a risk asset. And as a risk asset, it's no surprise that it's behaved the way that it has over the last 2 years.
And do you think eventually that changes? What's kind of your long-term thesis on what Bitcoin becomes? Is it an inflation hedge? Is it a store of value? Do you see it as like a fiat replacement? What's your thesis?
Yeah, my view of Bitcoin over time is that the trope basically of digital gold. Now, digital gold, like if you think of gold, now is gold an inflation hedge? Kind of. It's kind of an inflation hedge, right? I mean, gold has not actually performed amazingly at a time when inflation has gone vertical. So if something actually is an inflation hedge, it should have made money this year. It turns out, like, what is inflation? Inflation is the price of goods has gone up. So what is actually an inflation hedge? The answer is goods. Goods are an inflation hedge because that's what inflation means. Inflation means goods became more valuable relative to money. So like the thing that is the real inflation hedge, like oil. Oil is a good. Oil is the kind of thing you want. Cars are inflation hedges. Cars went up in value, right? Like physical goods are the things that are actual quote unquote inflation hedges. So to the extent that gold is an inflation hedge, it hasn't performed that function very well. Now it is a hedge to other kinds of things, and there are times obviously when gold is attractive when fiat currencies devalue or get debased. But that I think is the role that Bitcoin is likely to end up playing. But it's going to take some time to get there. The reason why it's going to take time to get there is that a lot of what Bitcoin is trading on right now is the future prospects of that adoption, right? Which is the question of if Bitcoin does become digital gold, it might not become digital gold at all. But if it does become digital gold, how long will that take? Will it take 5 years? Will it take 10 years? Will it take 20 years? And that time horizon, when interest rates are zero, it doesn't matter how long it's going to take, right? You basically just price it at whatever it's going to be eventually priced as, because interest rates are basically, you think of interest rates as the discount rate. So if the discount rate is 25 basis points, then that means that every year that it takes, the opportunity cost is another 25 basis points, which is almost nothing. But if interest rates are 5%, then now all of a sudden it really freaking matters if it's 5 years versus 10 years versus 20 years. And so things that are long dated bets really start getting repriced aggressively when interest rates go up. And so that's part of the reason why Bitcoin has gotten hurt so much, is that Bitcoin's a bet on the future. It's a bet on how long do you think it's going to take for this thing to grow into its eventual valuation of becoming digital gold. And so, I think it's going to take longer than most crypto people expect, but shorter than the naysayers expect. The naysayers say, 100 years, 50 years, whatever. It's going to be faster than that. And the crypto people are like, oh, it's going to take 3 years. And no, it's going to take longer than that.
So judging by your answer, maybe like around the decade mark, 1 to 2 decades.
I think that sounds 1 to 2 decades sounds reasonable. I would probably say that that's the right time frame. A lot of it is really just age.
Historically, that's a pretty good performance. Like if you look at how long like the stock market took to get off its feet and other emerging technologies, even if you go back all the way to like the first internet stocks, like they took longer than that. So even 10 years in the scheme of things, it isn't really that long, is it?
That's right. I mean, look how far crypto has gotten in just the first decade, right? It's been, since Bitcoin about 13, 14 years, and Bitcoin now, like, it's hard to find people who don't know what Bitcoin is. The level of the meme penetration has been absolutely incredible. It's been massive. Same thing as the internet, right? The internet in the first 10 years, everyone had heard of the internet. Did everyone use the internet? No, not at all, right? It took much longer people to use the internet, feel comfortable with the internet, find ideas of what the internet was going to be used for. But the concept of the internet penetrated very quickly. And the same thing is true for Bitcoin. The meme's gotten a lot farther than the actual financial asset.
So looking back to last cycle, If we look at what the top performers were, like it was pretty clear it was the L1s. So obviously your Solanas, your AVAXs, your Phantoms, they did 1,000+ X returns. What's your view on the L1 rotation in the future? Do you think the L1 narrative is dead, or do you think we're kind of going to see an L1 resurgence?
So first thing is that not giving investment advice. So take everything I say as just like a kind of general view of the market. I don't think the L1 story is going away for a couple of reasons. So one, I mean, what we've seen in the last year is massive drawdown in the non-EVM chains. So huge drawdown in Solana, huge drawdown in Near, huge drawdown in anything that was not EVM. The EVMs, on the other hand, have actually remained quite robust. So obviously Ethereum has been, held on to value the best. Polygon has held on to value very well. AVAX has held on to value not great, but okay. But the non-EVMs have really gotten crushed. I think now, if you look at the top chains by TVL, 9 of the top 10 chains are EVM. Actually, all 9 of the top 9 are EVM. What we've seen now is just total EVM supremacy over the space of smart contract chains. Now, that being said, I don't think you should infer from that like, the L1 story is over. We're just going to use Ethereum, and that's that. Because of the fact that, look, Ethereum still has the exact same scalability problems that it has when all this started. And even the EVM-based L1s, whether it's Polygon or Binance Smart Chain or Avalanche, the EVM-based L1s, fundamentally, they still have not actually innovated on the EVM itself. All of them are bottlenecked at the fact that the EVM is stuck. It cannot do more than something on the order of 300 to 500 transactions per second. That's the max you can do. If you take the EVM, you jack it up to 11, and you kind of run it until pieces are flying off the car. That's the best the EVM can do. If you want more than that, which I think we do, you need to have better than what we can do right now with EVM. And that means either one, the EVM needs to be re-architected and significantly improved, kind of in the way that JavaScript was in the early days, where JavaScript is now a super performant language on the browser because of all the work that Chrome and Firefox and all these browsers have done optimizing JavaScript. Either one, that needs to happen to the EVM, which right now is not really happening. Today, almost every single client or almost every single L1 is just using Geth. They just take the EVM implementation that's in Ethereum, fork it, and shove it into a new blockchain with a new consensus mechanism. That's fine. It's great. You can run that very fast, but you're not fundamentally improving on the constraints of the EVM itself. Or two, you have to take a non-EVM approach. And fundamentally, it doesn't matter actually if you talk about rollups, talk about any other architecture. All these things are still using Geth under the hood. And until you move past Geth, you're not going to see significant improvements in the underlying scalability of these blockchains. And we know they have to improve for blockchains to really get to prime time. So for that reason, I don't think the story is written on alt L1s, and ultimately, the operating systems for blockchains will continue to iterate. Right? I think what we have right now is that we realize the EVM is pretty good. It's kind of like we got to Windows 95. And Windows 95, it's like, okay, Windows 95 is like usable. Normal people can use Windows 95. It's pretty good. You can create apps, Windows. We've got all the primitives in place, but there's going to be more iterations of operating systems. Like, we're not done. There's so much more work to do. So that's why I say that no, the alt L1 story is certainly not finished.
Last week, Jordy said that he thought maybe it was dead just because of kind of the last cycle, there was this huge demand for block space. Now, obviously, with the having less users using the market, there's not as much demand for block space. And he thinks maybe with all these chains, there's kind of too much block space. So we have the opposite problem. Do you think that that's a genuine threat to kind of the L1s going forward?
No, not really. I mean, this is obviously very cyclical, right? So demand for block space is extremely cyclical, which we know. If you just look, demand for block space was super high in the 2017, 2018 cycle, and then came back down when the cycle ended. So we know that these things are cyclical. Ultimately, you have to draw the line forward past, the next 6 months. Yeah, yes, I agree. In the next 6 months, there's not a lot of demand for block space, and there's more block space than there is demand. Ultimately, in the crypto industry, we are on the frontier. We're pioneers, and we're pushing west. And as you're pushing west, the question that you could ask yourself is like, okay, there's all this open land. who's ever going to use this land? We only have like, 1 million people in America. What the hell is all this land going to be used for? Isn't this all just a giant waste of space? And look, at the time, it certainly looks like that. But the reality is that as you erect more and more space, you create more room for applications, more room for stuff to happen. But it takes time to develop that space. If you are convinced that this is in fact the frontier, and we're not just exploring, the Amazon rainforest, right? The Amazon rainforest is still undeveloped because it's just a giant rainforest, and it's like, look, people are obviously tearing it down and doing terrible things to it, but they're not living there. But ultimately, if you are right that this is in fact a great frontier, and there are a lot of important resources to be harvested from this frontier, then the idea that, well, there's only going to be really one city or a few cities, and they're all, the old colonies, Boston and New York and Massachusetts, Philadelphia, these are the places that matter, and nothing else that you do out west is going to matter. If that's your mental model, then that's your mental model. That's not my mental model. My mental model is that there's so much more stuff that's going to be done in blockchains over the next decade that, of course, you need more than Ethereum.
So that's kind of, you said interesting, like there's a lot to come. I guess one of the major criticisms over L1s is like, we're going to see rapid improvements. We're going to see new L1s come out that improve on their predecessors. Does that mean, in your opinion, is it worth investing in the old gen L1s, like from the last cycle, or is it just better to keep liquidity for the newer ones that are going to be launching over the next year that maybe improve? Like obviously we've got Sui, we've got Aptos, Say Network, just to name a few. Do you think it's worth investing in the old ones?
I think the answer is it depends, right? There's no single answer. It's kind of like, I really like analogizing L1s to cities. And the way that I would analogize this question is like, look, do you think that the old cities are going to be successful, right? Like, do you think that, Providence, Rhode Island, or Boston, or, New York, do you think these are going to be successful? Or do you think the new cities are going to be successful, like LA or like, Chicago? Do you think these cities are going to be successful? And the answer is both. They're both going to be new cities that are successful, and there are going to be old cities that are successful. There are going to be some old cities that fail and fall into irrelevance, and there are going to be some new cities that never end up getting off the ground. So it's always a matter of what is this particular L1 doing that is different, that is differentiated, that is ultimately going to be important 3 to 5 years from now. The answer for some of them is nothing. And the answer for some of them is everything. And so it really depends on the facts and circumstances. I think there's some old L1s that are going to be very successful and some new L1s that are going to be very successful.
So there's a theory, as you probably know, called the Fat Protocol Thesis, that the dApps actually accrue more value than the layer one itself. Firstly, like, how do you view this argument? And do you think from an investment standpoint, we should be focusing on investing in the L1s, or should we dedicate more of our capital towards the apps and identifying the strong apps on those chains?
Yeah, so the Fat Protocol Thesis, it's actually the inverse of what you stated. The Fat Protocol Thesis is the idea that in the traditional internet, the internet infrastructure, right, like ISPs, routers, all that stuff, they made very little money. And the applications made almost all the money. So Facebook, Google, Instagram, they made all the money, right? So the applications capture almost all the value, and the infrastructure is like this thin layer.
I think
in blockchains, it's the opposite.
Maybe I worded it wrong.
Yeah, right. But in blockchains, it's the opposite. In blockchains, the protocols seem to make all the money. Ethereum is worth, hundreds of billions of dollars, and then the applications are like, well, Uniswap is like 5 billion, and this thing is 1 billion, and then it's like tiny little strips on top. And so it's called the Fat Protocol Thesis or hypothesis. It's really more of an observation than it is a thesis, in the sense that it is noticing that is the case. It's not like making a claim that then got verified in practice. It was true even at the time that it was written that the protocols were worth way more than the applications. And it continues to be true that the protocols are worth way more than the applications. So the question is really, okay, the Fat Protocol observation, why is it true, and will it remain true? I think part of the reason of why it is true is analogous. Again, if you go back to the cities analogy that I was making about L1s as cities, it demystifies a little bit of what I mean, which is, okay, another way to phrase the same question is, how much of the value from the Silicon Valley tech industry was captured by the city of San Francisco? And the answer is a friggin' lot of it. Because if you look at property values, you look at taxes, you look at all this stuff, it's insanely high. So San Francisco is one of the fattest, most expensive cities in the world because of all the rent they were able to capture from all the companies that were built in Silicon Valley and in San Francisco specifically. And so in the same way, now, why is that the case? Why is it that San Francisco can capture so much value from all the companies being built there? The answer is because they have a scarce resource, and that scarce resource is land. Land is not infinitely extensible. In the same way, if you are built on top of Ethereum, the scarce resource is Ethereum block space. You can't make more of it. There's no more left available for you. And so the fact that there is this choke point in Ethereum block space, which is Ethereum itself, makes it so that Ethereum can capture a tremendous amount of rent in a way that is not true for the internet. The internet is infinitely extensible, right? If you have one router and you add another router to the internet, fine, no big deal. There's no limit on the number of routers that can be on the internet, right? And so, except IPv6 or whatever, IPv4 obviously, when IPv6, effectively there's no limitation on the total number of addressable entities on the internet. And so that means that actually the internet is infinitely extensible. You add more people and you add more, it's not the case that one ISP can be the choke point for the internet. It just doesn't work. There's always room for more competition. But in crypto, that's not the case, because crypto networks are more like cities than they are like purely extensible networks like the internet. That's one part of the reason why. But the other thing I want to say is that ultimately, we don't know that this is going to be true in the long run. A large part of the reason why this is true today is that blockchains still don't have that many users. And while blockchains don't have that many users, it's in some sense not surprising that the Ethereum is really valuable because people know that Ethereum is going to be a thing, but they don't know for certain what the applications are going to be that are going to be a thing, right? If you actually look back to the dot-com bubble, one of the most valuable companies in the dot-com bubble was Cisco, which was a company that made networking infrastructure, which was exactly equivalent to what Ethereum is today, right? We know that the internet is going to be really valuable, so we know Cisco is going to be really valuable, but we don't know what applications are going to be valuable, right? I think the analogy is actually quite apt, which is that part of this is a function of the fact that we don't know what blockchains will eventually be used for, but we do know they're going to be used. That's why people are very comfortable making a bet on Ethereum, even if they don't know for certain what application is going to eventually be valuable. But it's possible, it's certainly in principle, that you have an application. Like, what is stopping, just to give you an obvious example, what is stopping an application like Facebook? Let's say Facebook decides we are going to launch on Ethereum. Now, it's obviously impossible at their scale, but let's say they did it, okay? Facebook as a company is worth something like, $300 billion today. Boom, already you have an application on Ethereum that's worth more than Ethereum. Because Ethereum is worth what 100 something billion today? So boom, the fat protocol thesis is disproven, right? Well, no, it's like, it's a function of the fact of where we are in the development of crypto, that this observation describes reality today. But it's always possible that it may change. And it's a function of the kind of applications that will end up becoming successful on chain, whether or not we see the applications overtake the underlying infrastructure.
So from a kind of retail investment standpoint, would you focus like more of your capital and energy towards the L1s if your theory is true, or would you look at more like trying to like identifying dApps and trying to position yourself more in like the ecosystems?
I will respectfully abstain from answering that question.
Okay. Sure. The only reason I ask it is because I get questions all the time on my Twitter, like, Mars, is it better? Should I invest in NEAR, or should I, invest more heavily in kind of the apps that are launching on NEAR, like the DEXs and the, the bridges and all that?
I think that's the wrong. The way I put it, I think that's the wrong question. Howard Marks has a great saying. Howard Marks is a very famous bond investor. If you haven't read any of his stuff, strongly recommend reading his letters. He's one of the most brilliant investors in modern history. He has a saying that there's no such thing as a bad asset. There's only an asset at a bad price. So it doesn't matter whether it's a DEX, whether it's an L1, whether it's an NFT, whether it's whatever. There's no such thing as a bad buy. There's only a bad buy at a given price. So you give me the most horrendous looking L1 or the most horrendous looking DEX, and you offer me a low enough price, and that's an amazing buy. In the same way, you offer me the most amazing DEX, the most amazing L1 at too high of a price, it's a terrible buy.
Okay, makes sense. So in kind of 10 years' time then, seeing like the overall landscape, you said Ethereum's going to factor in quite heavily. How do you see like the landscape of L1s? What L1s do you think are going to be kind of up there or challenging, or at least taking some of Ethereum's market share? Or do you see it primarily like as being L2s? How do you kind of see the landscape of layer ones and L2s?
So I think it's very clear the star of L2s are rising, especially with the weakening of the non-EVM story. L2s are becoming more dominant. That is going to only increase after the Shanghai upgrade. So we're going to see probably maybe end of Q1 next year, this upgrade is going to take place, which is going to massively lower the cost of post and call data on chain. And when the cost of post and call data on chain decreases, that means that the primary cost for rollups, which is posting data onto L1, that is going to massively decrease. So you're going to see fees drop on all the L2s by an order of magnitude. That's going to be a big catalyst for these L2s to suddenly become very price competitive with alt L1s. The second thing, of course, you're going to see ZK rollups come to market, and ZK rollups that are capable of performing computations just like the EVM. So this is known as ZK EVM. Matter Labs, which we're invested into, is one of the big players here, building ZK Sync. There's also Scroll. There's also, of course, Polygon, which has their own ZK EVM. It used to be called Hermes. All of these are going to be coming to market next year. I think that's going to be a very interesting space to watch. But besides rollups, I think on the L1 side, again, EVM has proven itself as being a really dominant winner when it comes to the architecture for all these L1s. But in the long run, I think it's almost certain that there's going to be a non-EVM player, at least one. Now, is it going to be Solana? Is it going to be Near? Is it going to be Aptos? It's hard to say. But I think they're all playing for that prize. And that prize, I think, is a big one, which is who is going to be the high performance, low latency chain? There will probably just be one. It's possible that there's two, maybe three. Definitely no more than three. But I think it's likely there will just be one, in the sense that there's one that gets significant adoption. But they're all playing for that prize. And that prize is going to be quite massive. Even though we've seen some retrenchment this year, in the long run, it's very clear. A lot of use cases for crypto require low latency and high throughput. And the only way you're going to get that is with a non-EVM architecture.
You've also, obviously, you're an investor in Near, one of the tokens you mentioned, and you're presumably a fan of Near as well. Off the back of that, could you explain like what your thesis is around Near and why you think it could be challenging for that spot?
Absolutely. I mean, so Near, they've been one of the very first movers in the space of sharding. So there are basically two approaches to how to scale a blockchain. One is what's called vertical scaling, meaning you basically make a bigger and bigger machine. So, a lot of what you saw with, for example, FireDancer, which is Jump's new take on building a client for Solana, is basically you just throw more and more hardware, more and more specialized hardware, more bigger boxes, more RAM, more everything. And you make this thing basically very difficult to run, right? So the extreme is something like Definity, which literally can only run in a data center. So you need like basically a supercomputer in order to run a blockchain at a certain level. Now that thing is not decentralized anymore. On the other side, is so the vertical scaling is basically run a bigger machine, and that allows you to get more throughput and run things faster. The other option is horizontal scaling, which is you basically make a lot of chains run in parallel. This is how almost every traditional web infrastructure company actually scales. Is they don't scale vertically, they scale horizontally. There's no choice. There's no single server big enough to run Facebook or to run Google. In reality, they have the giant distributed system with lots and lots of machines running in parallel with each other. And when you do a Google search, and when I do a Google search, most likely our queries are actually going to different machines because they just have a bunch of machines sitting side by side waiting for your queries. So the idea is that, well, this is how almost all web services scale if they actually want to work at world scale. And so the same thing must be true in blockchains. So this was the Ethereum 2.0 story, was that they were going to scale through sharding, which sharding is a way to basically have these horizontally scaled machines that are all operating in parallel with each other. Near has been the first blockchain to really ship production level sharding at blockchain scale, and they're the first, probably most major sharded blockchain in production today. The other thing about Near that is really unique is that they're extremely developer friendly, and Near's story from the beginning has always been about developer adoption and developer go to market. And so the only chain today actually that you can write, actually not the only, I think also. What's her name? Shoot, I'm forgetting their name. They're a Cosmos SDK chain. Fuck, this is gonna kill me. Give me a sec.
You help me out. I might be able to help if you.
Yeah. They have a thing called Jesse, and it's called SES. Let me look this up. Jesse, SES, blockchain. OCAP.js. What is the name of this blockchain?
Doesn't even come up when you search it.
No. I know it's these guys. They have this OCAP model.
You're the exact same as me when I forget something. I like need to remember it or it drives me mental.
I need to. Oh my god, this is gonna kill me. Agoric. It's called Agoric. Okay.
Congrats. You got there.
Yes.
We did it.
Yes. Okay. So Near is the only blockchain besides Agoric that allows you to write smart contracts in JavaScript. JavaScript is the most used programming language in existence today. Literally, more programmers know JavaScript than any other programming language in the world. And today, now, if you want to write smart contracts in Solidity, I think the number of Solidity developers in the world is like in the 10,000 range, something like that. Maybe,
a lot.
Mid 10,000s, something like that.
Yeah.
That's not a lot. The number of programmers that can write JavaScript is in the millions. 3 orders of magnitude more than all of the programmers who know how to write smart contracts today. And so the story, I think, for Near is that, hey, if you really want smart contract programming and blockchain programming to go mainstream, you need to make it available and accessible to a much wider swath of programmers than to whom it's available today. That's a large part of the Near story. And just the fact that they're super high quality team. One of the founders of Near, Ilya, he was actually one of the co-authors on the paper that invented the transformers architecture, which today is used by GPT-3 and Stable Diffusion and all the crazy renaissance in AI. Ironically, before Near became a blockchain, which I know because we invested in the seed round of Near, they actually pivoted from being an AI company called Near.ai. And they ended up pivoting into blockchain because they thought that, oh man, AI is so hard, the problems are so complex. Blockchain, on the other hand, like all the blockchain developers are so crappy. Like they don't know what they're doing. They keep getting hacked, all these simple mistakes. And so they thought, hey, this whole thing about sharded blockchains, everyone seems to think this is so hard. I bet we could just build this and ship this thing way faster than anybody else could. And so they've got amazing world-class team full of, professional competitive programmers, and just pound for pound, one of the best raw talent teams we've ever seen in crypto. That was a large part of the reason why we ended up backing Near. And
so I want to ask about sharding just for a second. Because one of the major criticisms I hear of Near is like, oh, if Vitalik scrapped sharding, then what makes Near think that they can succeed? Could you maybe explain, like, because I know there's different types of sharding, and it's because Near shards differently to what Ethereum was going to, how they were going to implement it. Could you explain like the maybe misconception?
Yeah, actually, so in principle, it's actually quite similar to what Ethereum originally was planning to implement. Ethereum, what ended up happening was that Ethereum was so far behind their shipping schedule that, originally Ethereum 2.0 was supposed to be done many years ago. In fact, Vitalik, I think he originally, when Ethereum first launched, he believed that proof of stake was going to get shipped by 2018. 2022, wow. Right? 2022, it took finally for Ethereum proof of stake to get shipped, and nothing else in Ethereum 2.0 got shipped, right? So there's no sharding, there's no execution, there's no any of that stuff. So what ended up happening, there was supposed to be 3 phases. First was proof of stake, which is where we are now. Second was supposed to be shards, which is still years away. And then third was that the shards become executable, meaning that first they're just dumb data shards. So it's kind of like you've got your own baby Arweave. So you can just put data on there, but that's it. And then the final stage is that the shards become executable. So the shards are not just dumb Arweave, they're little baby Ethereums. So you can run smart contracts and do code and all this other stuff. Okay. When Ethereum ended up being so far behind their release schedule, they realized that, look, it's going to be so long until we get to stage 3 and actually get execution on the shards that we might as well just give up on it and say, look, rollups are the story. Rollups are going to happen way faster. Everybody else is working on rollups. It's not bottlenecked on the Ethereum Foundation. So you know what? Just do rollups, you guys. Screw the executable part. That's going to take forever. Rollups it is. That is why Ethereum dropped the idea of doing execution on shards. But of course, like, it would be way better if you could do execution on shards. It's just very complex. Now, the advantage, this is always true, right? If you take a network like Ethereum, which is this, $100 billion super tanker, trying to turn that thing around and totally change the architecture in place is insanely hard. It's like trying to land a space shuttle. It's super, super complex. But if you start from scratch and you say, you know what, we're just going to build this thing from the ground up, to be able to be sharded from the very beginning, then you don't have the technical debt. You don't have the constraints that you do, turning around. It's like, starting a new company versus trying to reform an old one. It's just much harder if you're starting with an old company as opposed to starting from scratch. That's the reason why I think Near is able to get, part of the reason why, also their competence and their technical abilities, but part of it is that they don't have the baggage that Ethereum has. And so I don't think it's true that, Ethereum decided that it didn't make sense to do sharding. The reason why is because they just couldn't ship it. It's just too slow. But I think we would like to, all things equal, be able to have ultimately sharded execution. And that's what Near gives you. It gives you that basically path to unlimited scalability without having to deal with, you're on this L1, I'm on that on L1, this L1 went down, this L1 had a bug, this L1 did this. Sorry, not L1, L2. This L2 had a bug, this L2 did this L2 did that. L2s are complex. They have a lot of surface area. They have problems. They are annoying. You have to have bridges. You have withdrawal delays. Like there are all these issues that happen with L2s that are not going to happen if you're just actually living in other shards.
Okay, so Near's one of them. You've also talked about some of the other L1s. You talked about some of the like ZK Sync, like Layer 0 stuff coming next year. Let's look into the future. What narratives do you and at Dragonfly believe are gonna like significantly make an impact on the space, and where are you looking at placing your bets heading forward into next cycle?
Yeah. Before I answer that, Miles, I got to go in about 10 minutes, just FYI.
Sure, yeah.
Cool. All right. So where am I looking to place my bets for the next cycle? So one, I think any time that you look at a cycle that has ended, you want to look back and see, okay, what were the biggest problems that got unearthed during the cycle? That is what we need to work on and address before we can pave the way for the next cycle. So what were the biggest problems this cycle? So obvious thing is scalability. We've already talked about that. That's L1s, L2s, that kind of stuff. Another big problem has been identity. So we don't have any notion of identity on chain still. There's really no single robust standard that everybody uses that allows things like on-chain credit, or that allows things like, hey, I want to be able to log into this game and that game and bring my identity over without necessarily being able to tell whether I'm a bot or not. Obviously, one of the things that we've seen in this cycle is the death of the airdrop. Airdrops used to be this amazing, beautiful thing that allowed you to reward people. And now it's this horrendous gamed, just nonsense statistic of like how many addresses are doing fake volume on your app or your, NFT exchange or whatever it is, right? So the airdrop has totally become corrupted because of the fact that we don't have a stable notion of identity. And so you create a new address, you create some fake volume, and that kind of breaks things. And so I think there's other things are like usability. Usability is still crap on chain, right? If you look at this last cycle, so many people came into crypto through, watching a TikTok video and learning how to install MetaMask and doing some crazy, like the amount of stuff that people did in order to get access to crypto, who clearly had no understanding of what they were doing, is amazing, absolutely incredible. But so many people lost money, got hacked, messed up their wallets, lost their seed phrases. Like the amount of carnage that took place from all the people who sort of ended up being collateral damage getting into the space because the usability of crypto is still so low was massive. And so that needs to be improved upon for the next cycle so that we can have normal people coming into the space and not immediately running into a foot gun situation and just, end up losing their Bored Ape or losing their private keys or whatever it is. And so security is another huge thing that very, very clear. Security was a massive problem this year, right? The total number of money that was lost in hacks this year, over $3 billion. Massive, massive, massive losses. I think this is probably the 2022 was the worst year for crypto hacks ever. And so it's clear that this needs to be addressed for this space to become more robust for the next cycle. And there's a lot of tools, both I think at the protocol layer and at the user layer, to be able to protect yourself security wise. And so look, in the midst of a bear market, it's tough to know exactly what are going to be the applications or the narratives or the consumer use cases that are going to drive the next cycle. I don't know. Nobody really does know. But the thing that you can be certain of is that, hey, the big problems that were unearthed in the last cycle, if you solve them, there's going to be a big prize for you waiting at the end. In the same way, if you look at the last cycle, like what were the big problems in the last cycle? Well, it's like blockchain scalability was a big problem in the last cycle, in the 2017, 2018 cycle. Price discovery on chain, like there was no way to really trade on chain effectively. Well, those things got fixed, right? We went from Ether Delta to Uniswap. That was one of the best investments of that vintage. We went from, CryptoKitties to OpenSea. OpenSea allowed you to suddenly get price discovery on NFTs and real liquidity. One of the biggest winners of the last cycle. Same thing with the things that gave you scalability, whether it's Solana, whether it's Matic, whether it's the L2s. Those are some of the big winners of the last cycle. And so solving those big problems almost always ends up resulting in a big reward at the end. Now, what shape does that reward take? It's never obvious at the time, but that is what I think is going to be the best investments of this period.
Yep. And I know obviously you don't want to make calls or anything, but can you make maybe give the audience just a few maybe projects to look into, or at least things you find maybe interesting that are maybe solving those problems?
Yeah. So I can speak to a few things that we've invested into. So one is Quadrata. Quadrata is an identity solution that allows you to basically KYC on chain without sort of giving up your privacy and showing people what your identity is. So it uses some fancy cryptography in order to obscure that from the sort of on-chain onlookers, but still allows an application to know, hey, you're a real person. And for example, let's say you're doing some kind of on-chain borrowing, and say, okay, well, I know who you really are, and I can use this to underwrite your creditworthiness in a way that's better than what you can just do on Compound or Aave, which is fully secured, right? There's no way to get unsecured lending unless you actually know who a person is and you have some kind of broader recourse. So that's one application that I'm very bullish on. Another one that we invested in relatively recently, of course, is Aptos, which we spoke about earlier. I think Aptos still early days for them, but I'm very excited about the Move ecosystem. I think Sui is obviously on the horizon, but Move is just such a unique take on how smart contracts should be written and how they should be developed. That I think there's still, although they faltered just as prices have come down, and L1s have just gotten really, especially the non-EVM L1s have gotten hammered this year. But on the whole, as just a young L1 and a young ecosystem with a lot of promise to see what can happen with the Move ecosystem, they've got actually a lot of interest, especially from traditional Web2 players who are very interested in building things on top of the Move ecosystem. And so that's one that I'm excited to see. I think there's still a lot of game to be played. And then the third, I would say, on the L2 side, we just announced an investment into Matter Labs, which is the company building ZK Sync, which is a ZK rollup, building a ZK VM. They're the first to launch a ZK rollup into production. They've been doing this for a very, very long time. Earliest, best shipping teams in the space. And they're the first to bring a ZK VM into production, which is currently operating today. So I am super excited to see what happens with ZK. I do think long run ZK is the future. And it's clear that more and more of crypto architecture is going to end up incorporating ZK from one degree to another. The one place where we still see this like Moore's law, like trajectory, like exponential growth, is in the efficiency of ZK. ZK is just, it's incredible, just this sponge of intelligence and creativity. And so it's one of the areas that I think you definitely want to be on the lookout for making big moves in 2023.
Are there many ZK products like available now, or most of them kind of like plays that'll come out next year?
Most of them are still relatively immature, right? So if you look at things like Loopring and Aztec, those are probably things that you can play around with today. Of course, Tornado Cash uses ZK. There's Zcash, of course, which is one of the OGs that uses ZK. But I think the biggest applications for ZK are going to be in general computation, and those are still quite nascent. It's going to take some time for those to become more mature and robust. But in the long run, I do think ZK is going to eat everything when it comes to computation over a long enough time horizon, but that will take some time.
I know you got to go in a couple of minutes, so I won't keep you too long, but I do want to talk about what you just said, and that's time horizon. What's kind of your outlook on 2023 now? Obviously, we're in kind of monetary tightening policy. The markets are bleeding. Things are looking bleak. What's kind of your outlook for 2023? Are we kind of nearing a bottom? Are we at a bottom? What's kind of your thesis there?
Yeah, TLDR, I have no idea. I made a lot of calls this year, not publicly, but sort of internally and privately, and I was wrong on a ton of them. So one thing I've learned, and one thing that certainly your audience should learn, is that people suck. People have no idea what's going to happen. Like, if there's one thing that 2022 has taught us, is that people have no idea what's going to happen.
Yeah.
So TLDR, I think the things that I have an edge on are things that are idiosyncratic to crypto. But it's very clear a lot of what determines crypto prices is going to be macro. And macro there's almost nobody in the world who has an edge on macro besides Jerome Powell. Jerome Powell has an edge because he knows what he's going to do, but nobody else knows what he's going to do. So at the end of the day, macro is going to be the tail that wags the dog when it comes to the crypto markets. But there's a lot of things endogenous to crypto that I'm very excited about and very bullish on. A lot of the blood has already been drained out of the market. Now, you can always go lower. There's nothing that stops more people from selling. But the things that looked the most frothy, a lot of the litany of things that I mentioned to you that blew up this year, to me, I'm like, great. That's almost all of them. Like, I don't know how many more kind of crappy, like sort of doomed projects are left to blow up. And so for that reason, I think actually the market is in a much healthier place, which gives me more confidence to be actively investing.
Yeah. And do you think from a retail perspective, like DCAing is the best approach? Because that's like an approach a lot of people take. Or do you think it's better to more kind of, I don't know, position yourself in kind of newer bets and maybe try and time the market a little bit more?
Well, one thing I would say, timing the market is never a good idea, just because, as I said, nobody is good at it. So if you're not good at timing the market, you probably shouldn't try. If anything, the average investor tends to be pro-cyclical, meaning they tend to invest at the top and they tend to sell at the bottom. And so if you don't time it, you're much less likely to end up being pro-cyclical. It's very hard to be anti-cyclical, but at the very least, just don't be pro-cyclical. That's the main thing, right? As long as you do that, you're going to do reasonably well. The other main thing I would say is that I don't think it matters so much whether you buy everything all at once in a lump sum or whether you DCA in. I don't think that makes a huge difference. I think the main thing that you do is to buy assets and then stop looking at them. That is the hardest thing. And so whatever it is for you that gets you there, whether it's buying in a lump sum or whether it's DCAing or whatever it is, the main thing is don't look at it every single day. If you look at it every single day, that's the thing that's going to ultimately end up getting you to make bad decisions.
Yep. Invest in quality and invest with a long-term time horizon. Well, I really enjoyed the chat today. I think you made some fantastic points. Hopefully we can clip it up and make it all controversial on the Shorts channel.
I tried to put a little bit of spice in there, but I don't know how much I actually got in the end.
You put a little bit. You're pretty reserved. I got to prod a little bit to get the.
That's true. That's true. We're regulated. We're regulated. So I got to be careful with what I say with respect to.
No, of course. I think we squeezed a little bit out, but no, thank you. Thank you very much for joining us. It was an alpha pack show as usual, as to be expected.
All right, it was my pleasure, man.
So awesome.
Thanks for having me.
Well, it was lovely. It was lovely to have you. Thanks for watching, guys. If you enjoyed the show, I'm going to be doing this every single week where I interview the biggest guests around the space. Smash the like button if you enjoyed. Share it with a friend. And, of course, subscribe for more content like this in the future. I will see you guys in the next one. Peace out.